Friday, August 7th, 2020, Maneco 64, home of alternative economics and contrarian views. Second video today, I'm going to look at the US jobs data, the market reaction, especially for precious metals, and at all the components of the job data. Also look at M1 money supply, M1 money velocity, and try to see what's going on really. It's very hard, of course, because we are in a situation where economies have been shut down by the government, by diktat, and we have no idea what's going on in terms of what they want to do going forward. In the beginning, it was shut down just for a few weeks to flatten the curve and then go back to normal, but it's far from that, right? So, FT says US added 1.8 million jobs in July as virus surge slowed rebound. That's true, but it was better than expected, the number. Let's have a look at the number here from investing.com. On-farm payroll, the expectation was for an increase of 1.6 million. It increased by 1,763,000. That was the whole non-farm payroll number. What I found more interesting, though, were like the government payrolls, for example. That increased by 301,000. The previous increase was 54,000, so a big increase of government payrolls. Then I looked at the government payroll chart, and you can see that a lot of government jobs were lost there after the shutdown or lockdown. Previous month, for June, it increased a little bit. So it looks like the government is rehiring again, 300,000. That's a big increase. So now let's look at the private sector, because in the end of the day, it's the private sector that creates wealth. The government can't run without the private sector, right? So let's have a look here. Private non-farm payroll. It came out in line, 1,462,000 increase, just a little lower than expected. So I wanted to look at the chart of that as well. And you can see that the job losses were huge after the lockdown there. I think it's almost 20 million. That's what that means. And then it rebounded, of course, up until June. It was going up. What's worrying here is the increase is not as big as the previous month. The rate of increase is decreasing while the government sector is increasing. Yes, we did get another 1.5 million jobs again in the private sector, but it dropped from almost 5 million the previous month. And before that, it had risen just over 3 million. So that's not a very good sign, I would say. The other components I thought were interesting, and this is to do with the Federal Reserve, with M1, with what nowadays is called inflation. And why do I say that? Well, because in my book, inflation is the creation of money and credit out of thin air, the excessive creation. And we have that, of course. A lot of people look at inflation more as rising prices. I see rising prices as a consequence of it. But be as it may, I think this could be a worrying sign for those who worry about a higher CPI. And it's the average hourly earnings. That's how much people earn on average. It was expected to drop by 0.5%. Actually increased by 0.2. That was month on month. Year on year, it increased by 4.8%. It's expected 4.1%. Previous month, it increased by 4.9. So let's look at the chart of hourly earnings. Yeah, you can see that prior to the lockdown, that wages were not rising as much as they are now. Yes, it's come off from around 8% right after they locked everything down. But that's probably concerning for the Federal Reserve, even though I don't think they're too concerned about inflation. But they're the ones who usually talk about tight labor markets. And it might sound a little bit counterintuitive to say that we have tight labor markets because there's still unemployment rate of 10.2% and millions of people out of work. But with all the money that's been flowing into the system, all the schemes to help people, this could be a problem in terms of the inflationary pressure, I would say. As you can see here in this chart, prior to the lockdown, we hardly ever saw that rate go up above 3.5%. Now it's going at a rate of almost 5 or even more in percentage terms. So I thought that was quite interesting. With that, I'll jump into the M1, which is basically cash and coins and also bank balances, checking accounts, or demand deposits out there. Look at the jump we've had. I've calculated that it's gone up by 35% since February. And it's an annualized rate of 85% M1 has grown. So we've gone from just under 4 trillion on February 24th. And the latest data for it from July 27th is 5.362 trillion. This is a 5-year chart here. You can see that this is an unusual move higher. And I'll put it also the maximum going back to the 70s. Yeah, this move is just worrying, I think. Of course, there are those who talk about the velocity of money or the M1 velocity. It has dropped, as we can see here, dramatically. We are at levels, not all-time lows here in terms of what's recorded, because I think we saw that lower back in the late 50s, but pretty close to it. But if you look at the 1-year chart, this all happened because of the lockdown. People aren't doing as much. The dollar in their pockets are not being used or used as many times or circulating as many times. But I would say with the economy coming back, yes, and it might not come back as well as people expect. We probably won't even come back to how it used to be before the lockdown. It could take a few years, but this is destined, in my opinion, to rebound the money velocity. And with the M1 money supply growth, I think it could be worrying in terms of the value of the currency out there. And I think that's why gold and silver are doing so well. That's why gold broke through the all-time high, in my opinion, recently at 1920. That's why silver is on a rampage, almost traded up to 30 overnight. I think the metals and also general commodities are starting to point to worries about the dollar. And why the dollar? Well, because when you have inflation, it's the value of your currency that drops versus real things. And I think we need to keep an eye on that M1 money velocity, see if it rebounds. That big drop there that we've seen is mainly because of the lockdown. Prior to that, yes, it was at low levels, but it wasn't at the lowest level ever. We're still at around 5.5, the money velocity. So right now we're near 4. So if that starts picking up, and it doesn't take much to do that, it's kind of psychological. It's all about what the Fed and the central bankers call inflation expectations. They try to convince people that there's no inflation, and then people believe it, investors believe it, and they keep buying bonds that don't have a yield, that don't give them any protection, right? So that's what's going on. Job data, I think it's a little bit concerning. Yeah, it was a good number, but and it was a little better than expected. But I think the private sector seems to be slowing down, as we saw, and the government sector is coming back online. Who pays for the government? Well, the private sector. I would expect the government to have to borrow a lot more, and that's going to hurt the private sector. That's maybe why the private sector employment is not picking up as well, because it's a big burden on the private sector. All the debt that the federal government is incurring, all the inflation out there as well doesn't help. And so there you go. Right now, spot gold is at 2,060. I think we dropped to 2,041 just after the number. So it's picked back up. It's down about $3. Silver got down to 27.52. So I told you a week or maybe a little more ago that after having broken that 21 resistance, silver, we're going to see some very interesting moves that we haven't seen in years. And that's what we're seeing. Intraday ranges of like $2.50. And that's just the beginning, I think. So right now, yeah, silver is 28.55. So it's rebounded $1 from the low since non-farm payroll. Stock market is down 68. The Dow future down 0.25%. Hopefully this has helped you a little bit in seeing what's going on out there in the U.S. economy. It's not much different here in the UK, I would say. I will talk a little bit about the UK soon. The furlough scheme is ending in October. I hear there's a lot of pressure already, not just from the opposition, but even people within the Conservative Party calling on Boris Johnson and the Chancellor to extend this furlough scheme, mainly because the Bank of England came out yesterday and said they didn't expect the economy to recover to pre-lockdown levels until the end of 2021. And you can bet that's probably optimistic. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. And think about subscribing to my channel if you haven't yet. I wish you all a great rest of the day. Take care. Bye.